So welcome to our private debt traditional and non-traditional players in the financial state system. It is an honor for me. My name is Juan de la Rosa. I'm a partner at DLA Piper Martínez Beltrán. And it's an honor for me to have two great, wonderful panelists, Susan Kasser and Sebastián Rendón. Welcome. Susan is founded and leads the 5.5 billion private debt business at Neuberger Berman. NB Private Debt is a direct lending program focused on lending to U.S. middle market companies owned by private equity funds in the U.S. They have investors from Colombia and Peru since its inception in 2013. And Sebastián is head of the financial institutions and other services team at Banca inversión Bancolombia, where he has originated and executed advisory in capital markets, M&A, structured financing, and syndications, as well as hedging strategies. During 2020, Sebastián participated in the mobilization of more than 2 billion with customers from several and educational systems, among others. Susan and Sebastián, welcome, and it's a pleasure and an honor to have you here.
Thank you. It's lovely to be with you.
Hello, everyone, and thank you, Juan Manuel, for the introduction. It is an honor to participate here with Susan and you.
So let's start. I think we can start with a first question, and maybe we can start with Susan. And the question is: in an entrepreneurs and funds coexist in the process of financing, are syndicates? Why don't you give us some ideas on this question?
Sure. So I'll answer for the U.S. specifically. In Europe, it's a different situation, but we're U.S. investors. So in the U.S., banks have moved out of the underwrite and hold model into the underwrite and syndicate model. So banks are going to be primarily involved for financings that are, think, $500 million and greater. And again, the bank's role is to commitment to the private equity fund so that they can go ahead and buy a company, but they don't intend to hold the debt. They're going to syndicate it either in the high yield market to investors or to the broadly syndicated loan market to investors. Alternatively, if you don't want a two-step process, you'll go to private debt funds, and private debt funds will underwrite and hold. So you have much more certainty. Now, why do you have certainty? Because with the two-step process, the bank has to incorporate what we call flex, pricing flex and terms flex into the document. So they'll agree to provide the debt with a range of cost and covenants and protections in the document within a range. And so if the market is receptive, then the borrower will end up paying less interest within the range. But if the market is disrupted in some way, then the borrower will pay at the very high end of that range. And so if you want certainty, is that for companies with less than 75 to 100 million of EBITDA or cash flow, it's always going to be privately placed. The banks won't touch something that small. But even for financings of $1 billion in size, private debt will compete actively with the broadly syndicated loan market.
Okay, and Susan, do you think that, in your opinion, are funds financing smaller or medium companies more than from banks, or not necessarily? In other words, does the size matter with respect to the focus on this? Your opinion on this?
Yeah, size does matter because the banks are so big. We've had, 25 plus years of bank consolidation in the United States. So for financings for a company less than 75 to 100 million of cash flow, think of a financing less than 400 to 500 million dollars. The banks just don't touch it because the financing fees are going to be percentage on dollars raised, and it's just not worth it if it's small. The other reason the buyers of these syndicated loans are buyers of syndicated high yield. Those of you who are invested in U.S. high yield or U.S. broadly syndicated loans, you expect liquidity. You expect to be able to sell any issue in your portfolio pretty quickly. And so the buyers of the syndicated debt themselves are not interested in financings that are less than, I mean, really, like the edge is 400 million, because they demand liquidity on the other side as well.
Correct. Okay, interesting. And Sebastián, what's your thought on the questions? I mean, how does this interplay probably in Colombia? What's your experience on this?
Okay. In the first place, Colombia's financial institutions have historically maintained an originate to hold mindset, meaning that a secondary debt market is practically non-existent apart from specific operations. For you to have a reference, 87% of loans are held by banks, while that retention rate in the US is around 10, 13%, varying with the economic cycle. And this has fueled in the US non-bank institutions, as Susan said, like investment managers, private debt funds, and CLOs. So all this leads to a conclusion, and the Colombia's market is way larger compared to other markets. And for the development, we need other investors to have a more active role here. For example, the private debt funds. So as we all know, the pandemic has left deep scars in the industry, and Colombian banks are not the exception. So in line with this, in the search for a correct risk assessment, Bancolombia has assumed a more active approach over its bank's credit portfolio by embracing an originate to distribute model, which aims to evolve to a market where loans are traded like any other over-the-counter securities, like in the US or Europe or even in Mexico. So this is not enough. We need other large local banks to embrace this model and to migrate to an originate to distribute, and maybe in the future, distribute to originate approach. But even more important, the market needs that the local institutional investors, pension funds, insurance, and etc., start engaging in the market under the current and new regulatory guidelines. Last year, the Decree 1393 passed the Congress, and it enables them to invest in debt, in private debt through debt funds. So finally, to answer your question, Juan Manuel, on how banks and funds coexist, so far in the start of origination of new structured loans, we've identified complementary capacities. So I would like to name a few. So the first one is the term loans. Due to the nature of the private debt funds investments and time horizons, it is more likely that they invest in longer term credits than banks, right? So there's a big opportunity here. And in those facilities where there is the need for bullet payments or back-ended amortizations, the fund can provide that long-term tranche. The second one is the project finance, as depending on the circumstances, risk policies may take banks away from financing under construction projects on their construction stages. So here's an opportunity for funds as they evaluate the long term overall. And to finish, the last one, but not less important, is as banks move towards a more active management of their credit portfolio, there's a benefit for funds in their investment stage to buy holdings from banks.
Correct. And Sebastián, what would you say? It's very interesting how you explain sort of the opportunities and the interface private debt funds may have here in Colombia. But what would you say, one or two, maybe you already hinted them out, what would you say are the major challenges is the real hurdle for these private debt funds to participate in Colombia's syndicated loan market?
That's a good question, Juan Manuel, because we've seen so many challenges, but I would like to discuss four of them, to name them, to highlight them. So the first one is the high expected investment return, which is depending on the segment, sector, rating, but it's 200 and 300 above average interest rate for banking finance because the liquidity is high here. The second one is limitations with prepayment options. Colombian clients, and you know well that Juan Manuel always prefer to have the option to make prepayments even with an applicable fee. These structures pose a challenge for debt funds whose reinvestment costs could be very high. The third one, limitations with project bonds. Given that pension funds here in Colombia can invest directly in these securities because they are registers, so it doesn't make any sense they go through a fund which will intermediate them, adding an extra cost. And fourth, and finally, we encounter several challenges in the operational front when it comes to execute a partial or total sale of a loan. For example, servicing, fronting, assignation of collaterals. So we both, banks and funds, must have our operational systems ready to participate in a trading market.
Correct. I agree. So let's sort of go to another related topic, and it's sort of leveraged by banks. I understand that these types of leverage has some associated risks. And Susan, in your opinion, what are those risks, mitigants that banks should have, and how is this interplay, or how can this work in a sense?
Yeah, so I like to organize asset leverage facilities, right, that fund managers like ourselves will use that are provided by banks, and you do it to amplify returns, right? That's the reason you do it. But Juan, what are the attendant risks? So I like to divide the types of financing that you can get into two quite different categories. One category I call easy to use, easy to lose. The other category I like to call really hard to use, but really hard to lose. And it makes sense because the bank is protecting itself either by making it hard to use or by being able to yank it from you, when you least want them to yank it from you. So the main players for this in the United States are Wells Fargo, Natixis, and Sumitomo Bank. We use Sumitomo Bank. And they all use the hard to use, hard to lose. And so what that means is that they have an underwriting team that is the same size as any direct lender. When you come to an agreement with them, you come to an agreement over how much debt they'll give you in total, what the maximum advance rate is on a particular loan, what loans will be categorically excluded from getting any leverage, and what the cost of the leverage is, and what the maturity of the leverage is, and what the covenants are. Then every single loan you would like to apply leverage to, they re-underwrite. And they can decline to provide even a single dollar of leverage against any loan. So their protection is that they're the loans, usually at a 66% advance rate maximum, loans that you think are already good loans. But if they don't like them, they can lend less than 66% or they can exclude them. The covenants would be on the portfolio in aggregate. So if overall debt to EBITDA in the portfolio drops by usually 20%, there's not sufficient collateral, they force you to post collateral. Or if interest coverage declines, one of those sorts of metrics. So your risk is not that they can yank the leverage from you, because they can't. One risk is that they stop extending leverage, because they can always do that. And the mitigant to that would be, one assumes that if they do that, it's in an environment that is very risk averse, in which case you're probably lending money at a much higher spread. And so you're probably okay. And then the other main protection, and this is something I would just recommend to every fund manager, if you're managing a fund that doesn't allow you to call additional capital from your investors, if you do get this collateral call, you're going to have to sell assets. But if you're in a private equity style structure, you can call capital from your investors. So as long as you're funds to pay down the asset leverage facility if needed. If in COVID, we actually didn't have to send a dollar. And so I think people are often surprised by how not only resilient some areas of the economy were in the US, but how many areas of the economy actually benefited from COVID. So it is possible to have a portfolio through COVID that did not need to send more money to the leverage provider. The other kind of leverage to use, easy to lose, usually has a mark-to-market trigger. And so the leverage provider is not re-underwriting every single loan. They're basically saying, okay, the way that I protect myself is if the world goes crazy, this index rate will drop, and then I'll demand repayment of the loan. That is obviously a much riskier type of asset leverage to use, but you can see why people are attracted by it. It's much easier to use.
Correct. And Susan, you mentioned the COVID, how COVID affected or has not affected the situation, but I need to ask this question now that we're talking about COVID. And has the pandemic affected the way in which banks are trying to mitigate these risks? Have you seen a change in sort of the view or the focus or the zoom there in the documentation, their protections? Have you seen that?
Yeah. So I'm glad you asked me that question, because actually we negotiated. Our Fund 3 went into COVID 80% invested. So Sumitomo and ourselves experienced the pandemic together, close to fully invested on Fund 3. And we negotiated another one with them for a future fund that we in November. And so we went to our existing provider and negotiated another one. The terms were exactly the same.
Wow.
So now I don't know if that's true for every single manager out there, because Sumitomo has told us that it is quite rare that they did not ask us for any money and we did not have to send them any money. So I think it's fair to say our experience, might be at the top of the league table, but I would be very surprised if overall people are backing off of this kind of provision of debt. It did very well in the global financial crisis. It did very well so far through the pandemic. But I am sure that there are particular funds that did worse. And so I'm sure that people could be more reluctant to provide leverage to them, or they change the terms, or they increase the price, et cetera. But it's certainly not an industry-wide phenomenon. And again, we saw no change in terms.
Okay, that's very interesting. And Sebastián, what's your thought on this? What are the risks and how are banks trying to mitigate this risk? What are the considerations from your perspective? Sebastián? I think Sebastián.
Okay, Juan Manuel, do you hear me?
I hear you now. I hear you.
These things happen, and I'm having troubles with the internet. So I lost you like 2 minutes ago.
No problem. The question was how the associated risk regarding to the leverage that private debt funds are adding value by being leveraged by banks, and what are the risks associated to this kind of leverage, and how banks are trying to mitigate these risks.
Okay. I mean, there's actually, you all must know that there are actually prerequisites of leverage to private debt funds provided by local banks, and it has become more evident now that these funds, private debt funds, are gaining traction and seeking opportunities in Colombia, especially in a context of historic low interest. So they're trying to find leverage at low cost and the same currency of the investment returns. It makes sense. But this is, I have to be honest, and this is new for the local banking system. So I would like to share with you, in first place, the main concerns I've seen banks have here in Colombia, and then I will move towards a structure that may work well, and I saw it worked out last year. So the main concerns are all related on how the information is presented to credit risk, and I'm gonna name three because of the time. So first of all, banks need to know the sector diversification limits, the ticket limits to check the risk appetite for the underlying risk, right? I know that for confidentiality matters, private funds do not share the use of proceeds with deeper information about the investment, but the investment in the end constitutes the payment source. So banks need to know more about that. An NDA could be signed always. And the information about the general partner and sources of leverage is needed, and track records and prior successful transaction are always helpful for the approval. So as I said before, the key question is that all these concerns applies to any kind of funds. The most relevant concern regarding to private debt funds is the payment source. So the question would be that what is the successful leverage structure for a private debt fund. So I'm gonna give you just 6 ideas quickly. The first one is a reasonable leverage structure of 20-30%. I know this is very conservative under international standards, but if there's a lot of certainty in the payment flow, low credit risk, and good sector diversification, leverage could be higher. The second, this is connected to the information, pari passu disbursements or after equity, because the banks do not know about anything about the investment. The third one, guarantee schemes. This is actually the key to success from my experience last year. The credit portfolio constitutes the guarantee itself, right? And all the payment flow goes through a fiduciary mechanism. Over collateralization may be required, and it falls within 1.1, 1.2. I've seen those numbers. In case of defaults or prepayments, the replacement for a new credit from the same credit portfolio to keep the scheme, the guarantee scheme intact, and to prevent prepayment acceleration. Fifth, in certain cases, guarantee in case of a defaulting credit. And the last one is, given that the banks have gone through many defaults in the agricultural sector here in Colombia, where a fund was behind and wasn't in the investment period. So in such cases, it would be helpful to leave from 2 to 3 payment periods here. So I think this is the secret sauce for a preliminary structure to start negotiating with banks.
Correct. And I guess, Sebastián, you talked about capital calls. Let's pause there and let's think for a minute. How do the use of bridge financing, which typically, are guaranteed by capital calls, could be incentivized? And maybe we can start with the U.S. and what's the experience there in the U.S. and then Sebastián, we can go to Colombia. So Susan, why don't you tell us about your experience in the U.S. and how has this evolved?
Yeah, it's interesting actually. I think if you think about the history of a cap call line, right, backed by the commitments that the investor make to the fund, this started with private equity funds. And private equity funds make, 10 to 20 equity investments. I mean, that complexity, there's a lot of complexity in terms of operations and running those companies. But from a fund management perspective, that's not very complex. If you think about the fund that we're running, we love diversification as long as it's not at the expense of quality. And so in our funds, we'll have 100 different loans. Almost all the loans will come with revolver commitments. Many of the loans will come with delayed draw term loan commitments. And so if we did not have a capital call line, we would be asking our investors for money every other day because we have a full cash desk that's just managing cash flow through the portfolio every day, right? Some of our issuers pay us monthly, some of our issuers pay us quarterly. I mean, there's just a lot of cash moving around. And so you must have a capital call facility in order to make the investors feel okay and be able to fund their commitments, right? We try to keep our capital calls quarterly, right? Very much in distinction to how we actually manage cash. And I would say actually the trend that we're seeing from investors is that even quarterly capital calls, they would almost prefer not to have. And we have a lot of conversations with investors where they say, you know, maybe we'll just give you the money and you can manage it in liquid securities, right? Cash strategies, broadly syndicated loans, other, you know, more liquid alternatives to private debt, and then just call the capital from there. And I think that if that's the direction that ultimately the industry goes in, you'll see now you need capital call facilities to run your business. At some point, you might not need or want them at all.
Correct. And I guess probably there's a relationship between bridge financing and the IRR of the investments. Do you think, and I've heard this in several use of bridge loans, do you think it's sort of a trend now?
So sort of yes, sort of no. So I think people love to ask the question. So let me tell you the pro and the con. So using the cap call facility ups IRR, right? Which means that the chance that you clear your hurdle rate goes higher, right? So our hurdle rate is 7%. And so, you know, if you thought you were pretty close, you use the cap call line a lot, boom, you'll clear it. But here's the problem with using a cap call line. You have to pay for it. That's right. Every call provider is $1 that you have to return, in our case, 7% on, before you can take a profit share. And so, yes, the use of a cap call line increases the probability you will be in carry, which is a binary test. You either are or you aren't. But it reduces the dollars of carry that you can get. And so if you think about the application where somebody would be using it, in my opinion, would be using it for that, it's like they can barely clear their hurdle. And that's why you would use it. Because if you know you're going to comfortably clear your hurdle, it's not helping you, right? Like, you're going to clear your hurdle anyway. There's just less money to divvy up. And so that's what I think actually ends up happening with them.
Okay. So,
and by the way, if you've invested in a manager that can just barely clear the hurdle, we have a different problem.
That's right. That's right. That's right. That's evident. That's right. So, and Sebastián, what do you think about the Colombian situation or context? Do you think bridge financing by private equity funds could be incentivized? Do you think this is something that we're feeling comfortable more and more about how capital calls work, and how could they be enforced, etc.? What's your vision on this?
So from a bank's perspective, I would like to say that I've seen few private equities funds, and personally I haven't seen any debt funds that include the capital call line in their LP agreements and bylaws, right? And Susan explained why very well. And those that have them are usually under foreign regulations, of course. Though this is the rule, local banks do not feel comfortable regarding the enforceability under a jurisdiction different to the Colombian one, right? So from a legal standpoint, the letter of commitment for capital calls, and Juan Manuel, you could complement me here, must always contain a clear, manifested, binding, and enforceable, very important obligation for the investor under the Colombian law. And this is why this is a nightmare for funds. And very important, it must explicitly state under which conditions banks may call those lines. Additionally, and I've seen cases that failed here in Colombia because it is quite important that the third party, in this case a bank, other than the general partner, is unable to call that capital injection, and they're not subject to the general partner to do so. This works well, and we've done so many bridge loans with capital calls when there's a local investor behind. But in the case of non-resident investors, if structured correctly, it could also be considered a mitigant. But again, a third party legal opinion will always be required to make sure it is enforceable in other jurisdiction. And just one final thing I would like to add up is I've seen a guarantee scheme with an equity call commitment and plus the investment shares to help with the approval. And the rationale behind is that banks with the shares, banks feel they have an alignment of interest with the funds, and they diminish the likelihood to keep in their on their balance sheet a long-term credit with an unknown payment source, because banks do not know the final investment.
Right. So Sebastián, if we bringing it down, trying to in practical terms, and given the current financial situation in Colombia with how banks are considering the market, do you think we have a future incentivizing these types of transactions? Do you think this is something that you foresee in the short term or even medium term?
Juan Manuel, this is a short question, and definitely yes. I've seen at least banks' willingness to explore this type of financing. There are not statistics, but anecdotes that support this. And those that have failed in the attempt, it is many explained reasons. And as I stated before, because of the lack of the information about the investment. And the second one is because of the enforceability. Banks need to make sure the equity calls is enforceable.
Okay, so I think we ran out of time. So I don't know if there's any questions from someone.
No, Juan Manuel, we don't have any questions. Thank you.
Okay, so Susan, Sebastián, it's been an honor. It's been a pleasure. Thank you for giving us all these ideas, and well, a very interesting topic indeed. Thank you so much.
To share this panel with you too. Thank you very much and have a good day.
Thank you. Thank you. Okay. Bye-bye.